Chapter 11, we're looking at common stock and paid-in capital and preferred stock, treasury stock, and dividends. A lot of terminology to know. I want you to look through this section, read through it, and before you watch any part of the video in example 1. I think the best way to teach this chapter or create videos for this chapter is to cover the examples. But before I cover an example or work a problem, let's look at this right here just to cover our basis and make sure they make sense as far as the concepts we're learning. So hopefully by the time you've watched this video or this part of the video, you did stop the video and you read through what I asked you to. Maybe even have worked the Learn Smart book for chapter 11. All right, so ownership cannot be easily transferred. That is a major false statement. That is one of the advantages of a corporation. Owners have limited liability in corporate stock, so that is false. That's one of the advantages, limited liability. So unlimited liability is just false. Capital is more easily accumulated than with most other forms of organizations. Absolutely, that's one of the advantages of a corporation. Corporate income that's distributed to shareholders is usually taxed twice, and that is true. Dividends are paid after net income tax or after taxes are paid, or with net income, and then usually the company or the individual receiving dividends pay taxes on that dividend. So there is double taxation. 5, it is a separate legal entity, so that is true. It has a limited life. It has a limited life. That is not true. They can last a very long time. Ford Motor Company, for example, well over 100 years old. 7, owners are not agents of the corporation. True. And that, if you haven't had a lot of management classes or any management classes, that might be a brand new concept to you. But owners, nobody represents a company better than the owner. So a sole proprietor or a founder of a corporation that owns a lot of the stock, they are not agents. They have an ownership interest. When you hire somebody to work for you, they're your agents, and agents don't have the exact same perspective if you own the company, not a vested interest like the owner. For example, most renters probably don't take care of the apartment or the house as well as the owner would. So ownership, agency, major concepts. Not enough time for us in the accounting course to go into it. Again, please read these sections here. I'm going to cover them as we go through the problems, but until then, I'm going to let you read them. Example 1, prepare journal entries to record the 4 separate issuances of stock. A corporation issued 4,000 shares of $5 par value common stock for $35,000 in cash. Well, it clearly says we got cash for $35,000, right? So we debit cash for $35,000. We want to credit common stock not for $35,000 but for par value. 4,000 shares times $5 each, par value is $20,000. The difference between $35,000 and $20,000 is additional paid-in capital or common stock, or $15,000. $35,000 debit, the credits add up to be $35,000 also. And number 2, corporation has issued 2,000 shares of no par common stock, but it does have a stated value. So the stated value and the par value, as far as your journal entries go, treat them the same. They got $40,000 cash in this example. I apologize. No, this was for promotion expense. So the company's being formed, the corporation's being formed, they don't have a lot of cash. Promoters oftentimes take stock in lieu of being paid, hoping that the stock value will go up, and it'll be a very worthwhile endeavor. So promotion expense, $40,000 is expensed, no cash is paid. Paid-in capital, or APEC, or additional paid-in capital common stock, is $1 times 2,000 shares, or $2,000. The difference, I just realized I wrote that backwards. I You know what? I think I'm going to do it here. I think I'm just going to do it here. Be easier than changing all that. When I was completing these, I didn't realize I wrote it backwards. Yeah, so the additional paid-in capital over common stock is $38,000. That's the difference between the two numbers. Number 3. Now the promoter issued 2,000 shares of no par common stock to his promoters in exchange for their efforts, estimated to be worth $40,000. There's no stated value. There's no par value. So what we'll do, let's see if I can get on the same page. So what we'll do is we'll just debit promotion expense, just like we did in number 2. Except in number 2, we'll just put all $40,000 in common stock. There's no par stated value. Okay. Corporation issued 1,000 shares of $50 preferred stock. Now, preferred stock is often exchanged initially in the formation of a company. In my opinion, it's the best of both worlds as far as stock and bonds go. It's got some features of a bond and features of stock combined into one. $50 par value preferred stock, $60,000 in cash. So let's for sure debit cash, $60,000 first. And then let's deal with the par value. $50 times 1,000 shares is $50,000. Preferred stock, $50,000. 50 times 1,000 is $50,000. The difference between the two, which is cash received and the total par value of $50,000, goes to additional paid-in capital, preferred stock for $10,000. So basically, preferred stock, the journal entry, is the same as a journal entry for common stock. 1 and 5 or 4 are the same, except we have preferred instead of common stock there, right? All right, next entry. Prepare the journal entry to record issuance of 36,000 shares of common stock, assuming the shares have $2 par value and sell for $18 per share, $2 stated value and sell for $18 per share. Interestingly enough, the answer is the same for A and B. So if you could do one, you could do the other. Just like we did in the prior problem, stated value, par value, treat them all the same as far as the journal entries go. So, issuance of 30,000 shares. 36,000 shares times the selling price of 18 is $648,000. Par value is 2. So $2 per share times 36,000 is $72,000 in common stock. The difference goes additional paid-in capital common stock, and that is $576,000. And that because the stated value is also $2, A and B are the same entry, word for word. Pretty cool, huh? More issuances of common stock. Letter A, on March 1st, Atlantic Company issues 42,500 shares of $4 par value common stock for $297.5 cash. So debit cash, $297.5. Par value is 4. 4 times 42,500 is 170. So debt credit common stock for 170,000. Credit additional paid-in capital common stock for the difference, which is 127.5. B, Antigo Company issues no par value common stock for $70,000 in cash. No par value, no stated value. Just debit the cash and credit the common stock, both for $70,000. Letter C. MPG issues 2,000 shares of $25 per value common stock for $45,000 of inventory, for $145,000 of machinery, and acceptance of a $94,000 note payable. You can do that. It's pretty cool, huh? So you would debit, oh my goodness, you would debit inventory for $45,000. Debit inventory for $45,000. Debit machinery for $145,000. You're not going to debit notes payable for $94,000 because we're accepting that as a liability, so it has to be credited. Common stock has to be $25 par value . times 2,000. So 25 times 2,000 is $50,000. So this is really going to be your plug-in. You're going to take 190, which is the total of the debits, minus 94, minus 50, and we get $46,000. So basically, it's just your plug-in number. Anything exceeding the total of these two numbers, which is what, 144 from 190, will be your additional paid-in capital. I don't anticipate a C being on your exam, but it could be. Be prepared, okay? You never know. Let's get one more problem in this video. Example 3, prepare a journal entry to record issuance of 5,000 shares, $100 par value, 7% cumulative preferred stock for $102 cash per share. Well, there's 5,000 shares times 102 means the cash was debited. That's the amount of money we got, $510,000. The preferred stock is $100 par value times 5,000 shares. So you would debit preferred stock, $500,000. Continuing on, the difference between 510 and 500,000 is additional paid-in capital, $10,000. Number 2, assuming the facts in part 1, if Thomas declares a year-end cash dividend, what is the amount of dividend paid to preferred shareholders? Assume there's no dividend in arrears. We're going to circle back and talk about dividend in arrears later. We're just going to make that note that there's nothing in arrears, so when you're studying these and you're working these again, you'll be better knowledgeable about what we're doing. So there's nothing in arrears. We don't owe preferred shareholders for anything in the past. So we debit retained earnings. Some companies use dividends. I prefer, I'm in that camp. I like the dividends, preferred dividends, but whatever. Retained earnings is debited, and then we credit preferred dividends payable. Now, what about this dollar amount? Why is it $35,000? Well, it's par value is what we're going to use. So it's 5,000 shares times 100, $500,000. $500,000 times 0.07 is 35,000. That's why. So we always use par value. So remember when at the beginning of this video I said preferred shares have some features of a bond, some features of a stock. Well, one of the bond features is we go back to the face value, and for preferred, it's the par value, and we use the par value to calculate the dividend. So if it says it's 7% preferred, you go to the par value, and you use that to calculate your dividend, not the cash price, not the current market price. You didn't do that with the bonds. You're not going to do that with the preferred shares. You're going to go to the par price. For the bonds, you go to the face value. So you take the par value. In this case, the total par value is $500,000. I know you got that by now. Multiply that times 7% or 0.07 to get $35,000. This concludes the video, the first video on chapter 11. We'll be making another video for the rest of chapter 11.